And today we want to sum up reporting season, but before we do that, let's go to the two biggies at the end of the week, namely Rio and Ramsay, Paul.
Okay, let's start with Rio, Peter. Underlying EBITDA at $18.1 billion. That was actually down 2% on the year before. Earnings a little bit better, up 2%. So pretty neutral result in terms of the headline, and the market had largely factored that in. What was a little surprising with the Rio result was not that we had a special dividend, but the size of it. A special dividend of 243 US cents, or about $3.39 Australian. Add that to the normal dividend of 180 US cents, and that means shareholders are going to get in dividends when the stock goes X and gets paid on the 18th of April, around about $5.80 Australian. So that's a big chunk of money coming back to shareholders. Look, the largesse from some of these mining companies continues, Peter. That was probably the highlight. Balance sheet, look, on the slide in front of you says that net debt is down to just $8 billion US dollars. Two things to note about this. First, this was a company who had a truckload of debt a few years ago. It was almost considered to be quite vulnerable. A basket case. But two, that's the amount after they've paid the special dividends and paid some tax and a few other things. As at the 31st of December, they actually had no debt whatsoever. So it really shows how strong that balance sheet has got. They also announced the discovery of a sort of a promising gold and copper mine or mineral deposit at a place called Winu. In Western Australia. Yeah. What was the negative? The main thing, and we saw this in the BHP result, is that cost pressures are there in the mining business. There's negative productivity, so the iron ore per unit costs aren't coming down. There are actually some cost headwinds, particularly aluminium. To me, some of the best days of some of these miners is probably past it. They've done really a lot of work.
You're kind of at record high in many areas, but they're just coming off the boil.
And it's sort of like almost as good as it gets. So, I mean, look at Rio, it's at a 10-year high. Look, we know commodity prices are still supportive, and if the iron ore price stays firm, Rio will keep going up. But the hard work about restoring the balance sheet, getting rid of the non-performing assets, increasing production, getting more efficient, that's all done, and it's going to get harder and harder. So I think that the stock is now sort of, I won't say it's in the sell territory, Peter, but
it's priced to perfection. But
it's getting priced to perfection. If commodity prices go down, there's nothing to stop this. So I think it's sort of in the profit-taking area.
Okay, Ramsay Healthcare.
Well, look, on paper, it didn't look like a great result, but the market liked this, and actually, as a stock that's had a rather tough 12 to 18 months, used to be one of my all-time favourites. Yeah. And there's actually a few green shoots for Ramsay. So let's go through the result. On the face of it, core NPAT up just 1% to $290.8 million, and core EPS, earnings per share, up 1.2% to 140.6 cents. That doesn't look too outstanding. But they recently acquired a business called Capio. That's largely based in the Scandinavian countries. And that's actually a drag on earnings per share. That came onto the balance sheet in November. So EPS growth was actually up 1.9% if you take that out. But digging even further in the result, there are some positives. So Australian hospitals, which of course they're the number one provider of private hospitals in Australia, way in front of Healthscope. Revenue is actually up 4.8%, which is pretty good in that market. And EBITDA up 5.7%, so that was a real tick. France, they've had some problems. Look, that actually came in better than expected. So on paper, it doesn't look so good. Revenue up 2.3%, but EBITDA was up 5.3%, much better than the market expected. And what had been the negative, and is still the negative in this half, which is the UK business, while that was still a drag on earnings and EBITDA was down 9.2%, there are actually positive signs in the second quarter. And they're expecting a tariff increase to come through on the 1st of April. Now, that's all subject to National Health Scheme. It's very regulated in the UK. That's been a big drag on earnings, but there's sort of signs that might be turning around. So they were able to reaffirm their full-year guidance of core EPS of 2%, and that includes Capio, which will actually be EPS negative.
So is this in the buy zone, Paul, or what?
Well, the market rallied on the back of it. I think Ramsay is a stock for the portfolio. You may not be into this level, and maybe we're waiting for some market weakness, but certainly, when healthcare stocks are under pressure, the market's under pressure, Ramsay is a great company. It is a stock to think about as a portfolio stock.
Getting back in your good books.
And it's getting back in my good books.
Okay. Sum up the reporting season, Paul.
Well, at the top line, I think it's just been a tad disappointing. Now, it's not so much in the results, but I think it's more in the outlook statements, Peter. And this is where the companies talk about what they're expecting for the next half, the next 12 months. They haven't really gone out of the way to tell us things are really on fire out there, and that's probably been where the disappointing part. At the same time, there haven't been that many standouts. There haven't that been really terrible results.
It's a bit like the Aussie economy. It's mixed, isn't it?
It is mixed without sort of being able to pick too many winners and too many losers. But overall, just a tad disappointing. I think the real standout of the reporting season has been the shareholder payouts and the money that is coming back to shareholders. Now, part of this is due because the resource companies are coming to the end of their cycle of selling assets and want to give money back to shareholders. But it's also just as much about because of the possible change to an ALP government and the policy on franking credits. And any company out there at the moment is saying, look, we've got lots of capital. We can see what might happen come the 1st of July. Franking credits are of no value to us in our hands. They're of value in the hands of shareholders. Maybe we do something on the dividend front. So what we've seen are upsized ordinary dividends. We had a company like Woodside go to a 95% payout ratio. We've had special dividends from the likes of Rio, Wesfarmers, Fortescue and others. And of course, off-market buybacks. One announced by Caltex. Woolworths said it's going to do an off-market buyback now that it's the sale of its petrol business is cleared. These are all way of giving, dividends and franking credits back to their shareholders. So that's been the real...
And that money will be respent probably in the stock market because interest rates are so low.
And that's one of the reasons why the market hasn't gone down, Peter, because there is so much cash out there. Because it's got to find a home. Interest rates now are low and no one thinks they're going to go up. So income type stocks are coming back into vogue, dividends are coming back into vogue, and I think that's going to provide some pretty good support for the market.
Anything else?
Look, two other things. I think I mentioned before the excess returns from resource companies, the BHPs and Rios that have been selling out non-performing assets, getting more productive, getting their balance sheet in order. I think that cycle's and increasing productivity. That cycle's almost come to an end. So don't expect those sort of returns going forward. The other thing is I just caution there of what I call the China syndrome. We've had some very mixed results from companies that are doing business up in China. I think that's a cautionary tale, Peter, because these have all at times have been market darlings. A2 Milk has done really well, but two very negative results from both Blackmores and Bellamy's. So I think for investors, when you're seeing the China story, you've got to go in there with your eyes wide open and just realise that things can change very quickly. Yeah. We saw it again with a company like Crown. There's a lot of risk for these companies up there. They can do well, but look, it's not a free market, and I think as investors, just be wary of the overhype about China sometimes.
Yeah, a pretty good assessment, Paul.